On February 28th, a geopolitical conflict triggered a massive shock. As oil prices surged and recession fears set in, almost every asset class plummeted simultaneously. Stocks, government bonds, crypto, and precious metals all took a severe hit on the exact same day. That widespread drop leaves investors with a serious dilemma. Historically reliable assets, like gold and treasury bonds, are specifically held to protect portfolios during a panic. Yet, in this instance, they failed to act as a safe haven. The intrinsic value of these assets did not suddenly evaporate. Instead, the market experienced a severe liquidity crunch. Institutional and retail investors were caught in a wave of forced liquidations, aggressively liquidating their portfolios to acquire cash by any means necessary. This flowchart illustrates exactly how that scramble for cash operates mechanically. When investors borrow money to amplify their market positions, they use their existing portfolio as collateral. If prices drop sharply, brokerages issue a margin call to protect their loans. The investor is then forced to sell off their best, most liquid assets within 48 hours to cover the debt. The crash was driven entirely by a behavioral chain reaction of forced selling. Because the underlying assets remain structurally sound, their long-term value is intact despite the short-term drop. Over 25 years, global debt exploded to $111 trillion. To manage this, central banks inject currency. The M2 money supply moves in perfect lockstep. This model demands continuous inflation. Asset prices, wages, and taxes must increase to prevent the bubble from collapsing. Think of managing a fixed home mortgage. If you have a loan and your salary inflates from $100,000 to $150,000 a year, that payment becomes much easier to handle. Your income inflated, but the debt stayed the same. Central banks rely on that exact mathematical principle. Geopolitical black swans will always cause temporary panics, but the sheer, overwhelming size of global debt mathematically guarantees a long-term trajectory of mandated inflation and upward asset pricing. Knowing that the macroeconomic system is designed to inflate over time, the immediate temptation is to aggressively buy the current market dip. Many investors try to maximize this opportunity by taking on margin debt. They borrow money against their brokerage accounts to artificially multiply their purchasing power, hoping for massive returns if the market rebounds quickly. That leverage carries a ruinous trade-off. If the market continues to experience volatility or takes another drop, the portfolio faces catastrophic exposure. You end up paying interest on borrowed money while your underlying investments lose value. The moment your account falls below a required threshold, the brokerage assumes control. They will automatically liquidate your positions at massive discounts, permanently locking in your losses. When you face a 48-hour window to produce cash, you do not get to choose the terms of your exit. You are forced to sell your highest quality assets because that is what the market will actually buy. You sell what you can, not what you want. Leverage offers peak returns in a predictable environment, but it introduces an unacceptable risk of total wipeout during a black swan event. The optimal way to acquire assets during high turbulence is dollar cost averaging, or DCA. With DCA, you automate your investments on a strict, recurring schedule. Instead of trying to guess the exact day the market hits rock bottom, you steadily buy shares as the volatility plays out. The trade-off is straightforward. You will miss out on buying everything at the absolute lowest price, and your initial upside will be smaller than a highly leveraged trader's returns. In exchange for a slightly lower ceiling, you entirely remove the catastrophic floor. You carry no margin liability, pay no interest to a brokerage, and face zero threat of a forced liquidation. Patiently acquiring assets at a discount allows you to capture the upside of the recovery while completely eliminating the financial stress that comes with borrowed money. Deciding exactly what to accumulate within that DCA schedule is the next step. Broad U.S. index funds are standard, but holding only domestic equities leaves you highly exposed to concentrated market shocks. Protecting your purchasing power requires tangible assets. Physical precious metals serve as a mandatory hard asset hedge against the continuous expansion of the global money supply. This chart tracks the S&P 500 against gold over a 30-year span. Look closely at the inflationary gaps, where gold outpaces the broader market. This price action reflects fiat currency devaluation. It simply takes more devalued dollars to purchase the same ounce of gold. Allocating a portion of your portfolio to gold mathematically counteracts the intentional devaluation of global currencies over time. This matrix maps out the practical decisions available to you right now, weighing systemic risk against expected long-term benefit. Liquidating your portfolio to sit entirely in cash guarantees slow wealth destruction. The $111 trillion debt mandate means your cash will constantly lose its purchasing power due to systemic inflation. Utilizing heavy margin debt to trade the dip carries a high probability of total ruin. If you are over-leveraged in a volatile environment, the most pressing action is immediate deleveraging to protect your principal. The optimal strategy for 2026 requires strict discipline. Avoid margin debt. Run a steady dollar-cost averaging schedule and diversify across index funds and physical gold to capture the inevitable recovery. Short-term market panics and geopolitical conflicts are impossible to time perfectly. The mathematical expansion of the global debt bubble, however, is a certainty. By aligning your investment strategy with the macroeconomic reality of continuous inflation, you can comfortably survive the liquidity crunch and ensure your portfolio grows in the years to come.